You know, we are constantly bombarded by just an overwhelming wall of noise when it comes to financial advice. I mean, everywhere you look, someone has a hot tip. But most of that noise, it's really just designed to get you to buy a product, open an account, or chase the latest shiny trend. So, what actually happens when we strip away all the hype, the polished sales pitches, and the illusions? Well, in this explainer, we are going to do exactly that. Let's decode the unvarnished mathematical reality of money. Here is our roadmap for today. We'll be hitting 4 key areas. 1, the sequence of wealth. 2, the investing illusion. 3, the housing affordability trap. And 4, an overarching concept I like to call the invisible engine. All right, let's just dive right in. Starting off with Section 1, the sequence of wealth. Step-by-step riches. I want you to think of your money as climbing a very specific financial ladder. Step 1 is building a starter emergency fund of about $1,000. Think of this as your immediate firewall between you and total financial chaos. Step 2 is getting your employer match. Step 3, and this is absolutely crucial, is eliminating toxic high-interest debt. Yes, that 20% credit card balance literally has to go before you do anything else. Step 4 is maxing out a Roth IRA. Step 5, you circle back and max out that 401k. And finally, Step 6 is building a full, rock-solid 3 to 6 month emergency fund. The big takeaway here, skipping steps costs you real money because structure beats instinct every single time. 100%. Look, if your employer matches your retirement contributions, that is an immediate 100% return on day one, with zero risk. It is literally the only true free lunch in all of finance, and yet millions of people just leave it sitting on the table because they try to skip around the sequence. Let's zoom in on Step 4 for a second. You can think of a standard taxable brokerage account kind of like a leaky bag. You're getting hit with capital gains taxes year after year, and it creates this massive invisible tax drag on your wealth. But a Roth IRA, that's like a protective dome. You put your after-tax money in now, and those investments grow, and more importantly, stay completely tax-free. When you start withdrawing in retirement, you pay zero tax on the gains. And over a few decades, that difference is no joke. It can literally add up to hundreds of thousands of dollars. The structure you choose completely dictates the wealth you actually get to keep. Which brings us right into Section 2, the investing illusion. The whole debate of stock picks versus indexing. Picture this. It's 2008, and Warren Buffett makes $1 million bet. He wagered that a simple, incredibly boring S&P 500 index fund would completely beat a hand-picked portfolio managed by some of the smartest, highest-paid hedge fund managers in the world over a 10-year stretch. Now, the professionals had PhDs, complex algorithms, and just vast resources at their fingertips. The index fund had, well, nothing. It just passively followed the top 500 companies. Fast forward 10 years, the index fund had returned 125.8%. And those highly paid pros, just 36.3%. The passive index fund violently crushed the experts. 94%. Just let that number sit with you for a second. According to S&P Global, over a 20-year timeline, roughly 94% of actively managed large-cap funds underperform the S&P 500 index. Time is the absolute enemy of active stock picking. Why? Because compounding errors compound the exact same way that interest does. So it brings us to a really uncomfortable question. If the professionals, with all of their massive data centers and endless resources, cannot consistently beat the market, why do you think you can? Look, we all see retail traders posting these massive wins online, but that is classic survivorship bias. We see the very loud winners, but we never hear a peep from the thousands of silent investors who entirely lost their shirts chasing the hype. And the actual math behind the market's long-term returns is honestly mind-blowing. Think about the old needle in a haystack analogy. The entire net wealth creation of the U.S. stock market over nearly a century was driven by just 4% of the stocks. That's it. The other 96% performed roughly as well as safe, boring treasury bills. So, if you're picking stocks randomly, there's a 96% chance you're picking a total dud. But by indexing, you guarantee that you own that magical 4%. You don't have to scramble to find the needle. You literally just buy the entire haystack. Okay, let's shift gears to the biggest asset most of us will ever buy. Section 3, the housing affordability trap. We need to look at the true monthly cost of homeownership because it trips up so many people. See you buy a $280,000 home at a 7% interest rate. Your principal and interest might be about $1,863. Which doesn't sound too bad, right? But hold on, let's add in property taxes, insurance, private mortgage insurance, and a really conservative maintenance budget. Suddenly, your actual out-of-pocket cost is over $2,700 a month. All those hidden fees and routine maintenance completely obliterate the old 28% gross income rule. And this leads right into a very dangerous disconnect. The bank's math looks at your debt-to-income ratio, and they might legally approve you for up to 43% of your gross income. But here's the thing. The bank doesn't care about your grocery bill. They don't care about your childcare costs or utility bills. What a lender legally approves you for versus what you can actually sustain on your net take-home pay without drowning financially are two completely different realities. Rule of thumb, never let the bank's math dictate your lifestyle. Then, of course, we have the wait for rates trap. You've heard it, right? Everyone says, just wait for interest rates to drop. But there is a massive seesaw effect happening here. As interest rates drop, buyer demand violently spikes, and home prices shoot up on the other side. It's a refinancing asymmetry. Think about it. You can always refinance a rate later down the line, but you can never retroactively lower your purchase price. The old saying about marrying the house and dating the rate, it's mathematically accurate. Waiting around for a lower rate can permanently cost you the chance to buy at a lower price point. Finally, let's zoom out to the macro economy for Section 4, the invisible engine, the global bond market. Look, if you don't understand bonds, you don't really understand how money moves. So here's the absolute golden rule. When bond prices fall, yields rise. It is a permanent inverse relationship. And why on earth does this matter to you? Because these yields act as the baseline gravity for everything else in the economy. They dictate the mortgage rates we were just talking about, your credit card APR, your auto loans. When global investors get nervous, they demand a higher yield. And that means falling trust and rising borrowing costs for absolutely everyone. Which brings us to some, frankly, very uncomfortable math. For years, the government was borrowing money at near zero rates. But now, as all that old debt matures, it has to be refinanced at much higher rates. The result is kind of a financial black hole. Annual interest payments on the $33 trillion U.S. national debt are projected to exceed $1 trillion. $1 trillion. And that is literally just to keep the lights on and pay the interest. It is a surreal scale of debt, even for the safest borrower on earth. Now, keep your eyes on what happens to the yield curve. A normal yield curve slopes upward, right? It pays more for long-term bonds, which signals a sunny path of growth and economic stability. But an inverted yield curve happens when short-term rates actually push higher than long-term ones. That signals the storm clouds of panic. It shows investors rushing to safety. This specific inversion has preceded every single U.S. recession since 1955. It squeezes bank profit margins, tightens up credit, and creates the exact underlying conditions for banking collapses, just like we saw with Silicon Valley Bank.
The bond market isn't just some boring financial instrument. It is effectively a global voting mechanism. Political advisor James Carville famously summed it up like this. He said, "I used to think if there was reincarnation, I wanted to come back as the president or the pope. But now I would want to come back as the bond market. You can intimidate everybody." Governments can make all the political promises they want, but the bond market acts as this giant, ruthless scale, mathematically dictating what a country can actually afford.
Well, we have covered a whole lot of ground in this explainer today. From the optimal sequence for your paycheck, to the illusion of active stock picking, the reality of housing costs, and finally, the invisible engine of the global bond market. The entire system is incredibly complex, but the math underneath it all is very real. So the final thought I want to leave you with today is this. When the next crisis comes, and it will, and the headlines are just screaming at you, will you actually understand what the numbers are telling you? Thanks for joining me for this explainer. Stay curious and keep doing the math.